Hello, everyone. Welcome to F Street's Investor Roundtable. Today, we have a really exciting opportunity. We're releasing today the F Street Normal LLC project. Great investment project we're doing in Illinois. We'll go through a few of our other projects that we're working on right now that we finalized raising, that we have coming down the pipeline. We're really excited to talk to you today and about these great opportunities to, again, build your portfolio in alternative real estate. You've got Nick Young and Josh Leary.
Thanks everyone for your time today. Excited to chat with you. F Street, founded in 2009, we are focused on alternative investments in the real estate space, really focused on multifamily and industrial acquisitions, value add, creating above market returns, and then also development in the industrial and multifamily asset classes. So two of the opportunities we're highlighting today, one, as Nick mentioned, industrial acquisition in Normal, Illinois, and the other one is a ground up multifamily deal in a great market, with a great overall package in West Dallas, right outside of Milwaukee.
Yeah, absolutely. So talking a little bit about what we talked about, we're going to go over our multifamily development project and our industrial project. Just talking a little bit about F Street and our portfolio, going to our industrial portfolio, just over approximately 3.5 million square feet as of now, with the recent acquisitions over the last week here. And really want to go into what we look for, because we've talked about our deal traits, what we look for on industrial opportunities in real estate alternative assets to really ensure our investors create those outsized returns, beat the market, and have a great alternative asset. So first off, physical assets. I mean, 100,000 plus square feet, strong fundamentals, great infrastructure, good submarkets. Goes back to the old adage, location, location, location.
Yeah, so in addition to the actual physical asset, we're looking at the cash flow and the lease structure, right? Finding opportunities to create value for the investors. And we do that through restructuring leases, extending and negotiating with existing tenants to extend their leases, to bring them to market if there's a mark-to-market thesis, if they're currently under market, but we know there's a significant discrepancy, to push them to market with expiring lease term, or negotiating with them, providing them with some capital up front to incentivize them to maybe make some repairs on the building that are required or needed. And then in exchange for that, getting them to a 5, 7, 10-year deal. And what that does is it provides our investors with increased certainty of cash flow throughout their term, but it also increases the value of the property, right? So we might not touch the property, but we could increase the value by executing on one of these investment theses.
Yeah, absolutely. And one thing I do want to remember, and we didn't mention this earlier, we are live. So if anyone has questions, we do want to make this interactive. If someone has an immediate question while we're on a slide, we can go between slides here. We can move it around. So if anyone has questions, please ask, because our goal here is to go over the opportunity, to go over how the project itself and multiple projects, and answer those questions while we're on the live here. Going over what we're releasing today, F Street Normal. So this project is located in Normal, Illinois, which is Bloomington, Illinois submarket, 150,000 person submarket. Asset itself, it's approximately 326,000 square foot building in Normal, Illinois. Most of the asset, just over 300,000 square feet, is industrial warehousing space, a really nice laid out, perfect rectangular demisable building, along with a small piece of office space. So asset itself was built in 1985. So really going over why we love this deal. First off is the tenant. So the tenant in the deal is in the 305,000 square foot warehouse is a Fortune 250 company. It's Corteva. We've actually been working this deal for over almost 9 months now, coming up on 9 months, negotiating with the tenant for an extension, working with the current seller of the property, who's looking to retire at this point, to get that lease extended. So we've actually got they now have 10 years of lease left. Really the beauty here of this lease extension is they're below market. They're well below market, and those lease extensions are 2.5% each of the first 3 years. Year 4, we're seeing a 7.5% rent bump and 3% thereafter. So we really love that. And that's really to bring them up to market rents. They'll still be a little bit below market rents. And something about the actual market itself as well that we love is Bloomington. If you don't know the market, Bloomington, Normal, Illinois, essentially located in the state of Illinois, really has a massive supply shortage. So we'll talk a little bit more about that, but a huge supply shortage because Rivian has recently invested, or is investing, $1.5 billion into the submarket. taking over the old Mitsubishi facility, building their own supplier network.
Yeah, and when we talk about market fundamentals, right, and looking at current vacancy, there's not a lot of new construction or new spec development happening because of the cost, right? They're cost prohibitive. So we have a great existing building that we're buying at a great basis, right, with a great tenant in place who just extended for 10 years, and a non-for-profit that's been in business for 100 years who takes the remaining portion of the building. So we've really set the deal up for success. Great cash flow out of the gates, a significant increase in year 4, which drives value to the building, and allows us, as we'll get into, an opportunity to refinance the asset, provide liquidity, continue to cash flow, or we'll look at another scenario where we would sell the asset and monetize it for a significant value above what we're paying for it. So we can pop to the next slide.
Yeah. So again, why invest? Yep. That's what we're just talking about. Why invest? I mean, if we go back to the page here, I mean, just talking about Corteva, Fortune 250 company, A+ credit, you can't really get much better than it, taking up more than 85% of the revenue in the building. So that's really what it comes down to, is great credit tenant on a building we're buying well below replacement cost.
Absolutely, yeah.
It's
yeah, so for $38.50 a foot, right, to replace this property today would be well north of $60 to $70 per square foot, maybe more. It's in a great market with low vacancy, right? Nick kind of talked a little bit about Rivian and the fully occupied market. The vacancy is super low in the market, and then the term on the Corteva lease is significant, right, with the rent bumps implied. So super excited about the opportunity.
Yeah, absolutely. And there's other, great areas too. I mean, we talk about, Bloomington, Illinois, Normal, Illinois as a submarket. I mean, it's just a really built submarket that's now getting lots of growth with Rivian. State Farm is actually based out of there. It is the largest employer in the area. You have Illinois State University. And another one of the beauties of this building, and I'll just show what we really love about it. So here's a picture of the building itself. As you can say, really nicely laid out building. It was originally built as a manufacturing facility, was converted into storage. So great quality building. What we love too, and we can show this here, there's actually over 10 acres of additional developable space on the north side of the property. It's just off the highway. It's just off Highway 55, so great highway access. So even what we call it, we look at the back end fundamentals of industrial. What's your backfill? Well, first off, we have a lease for 10 years. They have 2 5-year extensions. They're going to be there forever, is how we look at it. If they're not, it has 8 megawatts of power. It actually has 2 substations built to it because it was old manufacturing, and expandable land. So it really develops all those fundamentals for a great long-term value play in real estate.
Plus the value drivers, right?
Right.
And we're not underwriting the excess land, right? If that's a sale or a future development, or we hold the land for a longer period of time. And with the power and the ability to attract a backfill user, increases our chances of doing so. So,
yeah, absolutely.
So just high level here, we always like to break down our sources and uses of capital for our investors. This is a pretty simple capital structure, pretty simple deal to follow. There's debt and equity. We're working with Wells Fargo right now and executing on our loan for closing at the end of September, and then $4.2 million of equity. And then this kind of shows where those costs are being allocated to. As you can see, the vast majority is in the purchase price of the actual building. And then, of course, we always have financing costs, soft costs, and other fees and reserves that make up the total capitalization of the project of the $12.45 million. And then just breaking down our investment structure, which is pretty standard if you join these calls and are exposed to our syndication deals. We have a model that resonates well, or has in the past, to keep it very simple. We pay a 7% preferred return on all outstanding capital, and then 100% of that excess capital goes to pay down you, the investor, first, to totally de-risk the investor, to make sure they're getting their return and all their capital back through cash flow, through refinance and sale proceeds, before any split happens with F Street, the sponsor. So as you can see, once 100% of that capital is returned, capital is split, or cash flow is split 50-50 between the Class A investors and the Class B investor.
So going over specifically like cash flowing in this deal. So we looked at, and I'll show you, we looked at multiple scenarios for here. In general, the project meets the fundamentals of what we love in industrial acquisitions. That negotiated lease with Corteva, Pioneer Corteva Group, and with the smaller tenant as well. I mean, the beauty of the deal is we can be very flexible. So we're paying an approximately 8.7% going in capitalization rate. And what we'd be look at now with this negotiated lease is likely a sale, talking with the current capital markets of a mid to low 7 cap rate. So we have immediate value the day we get this building. So we could actually look at selling it, putting it out to the market and selling it. This scenario we're showing is selling it in year one. So actually selling it, after year one, so we're outside of short-term capital gains, assuming the capital market's the same as it is today in a year. It could be better, it could be worse. We're just being very conservative and saying, hey, if in 1 year we look at talking with our brokers and saying, hey, would you want to farm this deal out to another investor group that might be buying it, looking for a different type of return profile than we are, this is the type of returns we look at. So as mentioned, essentially you're creating a 20 to 30% quick turn on this asset. And we'll explore that. And that's something we've talked about it as always. On any of our deals and any of our investment opportunities, we're going to target what works great for our investors. And we're going to be flexible with looking at scenario one, which is more of a short-term deal, and looking at it in month 12 to 24 to see what the capital market looks like. Or if we're looking at scenario two, which scenario two we love as well. It's going to the money trees philosophy we've built up with our investor base over the years on creating value as an alternative asset investment for our investors. And this deal, specifically, just looking at cash flows going in. So year one, we'll be looking at over a 12% cash on cash. The debt financing we're looking at, the first year is interest only. So that really helps bump that cash up. And then starting in year two, you're seeing 9+% over to 10%, averaging 10.5% for the first 4 years. And we talked about this earlier, that rent bump, that 7.5% rent bump in year four, in month 48, looking at a month 48 to month 50 refinance. Because of that higher net operating income we're going to have, we can refinance at a much higher rate or higher leverage to return. Essentially, we'd return over 100% of capital back to our investors. And then we call it money trees from there.
Yep. You're right. So, looking at this scenario, investors frequently ask, hey, what is the plan here? These are two realistic scenarios, very probable scenarios. We're going to evaluate both just to optimize the investment or optimize the return. If we have an opportunity, let's say capital markets compress, interest rates go down, valuations increase in the short term, might be a great opportunity to take advantage of. If you go back to scenario one, we might be looking at a 1.3x equity multiple in a year, right? So a 100 grand investor would yield 130 grand in just about a year, 1 to 2 years. So that's a great scenario. Flipping back to scenario two, the cash flow is great out of the gates, as Nick alluded to, right? So with that rent increase in year four, that maximizes value, allows us to pull out the liquidity, get investors money back, get investors money, their capital back, and allowing them to make other investments, whether it's with us or another group, but also staying in the deal, right? There's investors are in the deal until we sell the asset, and they're still receiving returns from the deal every month through distribution. So another really good outcome, and this kind of maps out what an equity multiple look like with some exit cap assumptions that are market driven to get to a 2x equity multiple here on a longer term hold.
Right. So looking at this portion, in the event this is a hold over a 5-year period, which is the type of finance we'd be locking in, investors receive essentially $130,000 of distributions in the first 5 years and still receive estimating $3,400 from a $100,000 investment every year in your mailbox on a monthly distribution. While you have all your money back, you can reinvest that money into other opportunities, other projects. We did show a year 7 exit just to show what an exit would look like. But again, knowing there's a 10-year lease and that lease will likely be in there longer. I think one of the cool parts about Corteva and what they have, what Pioneer has in the building is they essentially have almost $1 billion of inventory in this building. It's agricultural, it's seeds, it's what's American heartland needs in that area. So we know they'll be here. We know they're going to be in this area for a long, long, long time.
Definitely. So just highlighting the critical dates for the investment. Clearly, it's open today. We're announcing the opportunity today. All funds due by September 19th, and we're targeting an acquisition in lockstep with our lender, Wells Fargo, on September 19th. That might slip a day or two, but right in that window. So to secure your spot, please sign the subscription agreement in your investor portal. If you have any questions, of course, we're happy to jump on any calls and dig in deeper to any one of the slides or our model, et cetera.
Going over our pipeline, as mentioned, we did close 2 opportunities last week for our investors. We're releasing this project today. We'll likely be releasing another really great value add industrial opportunity next week in Arizona as we finalize the packet, finalize our terms with our debt. So that's another fantastic opportunity we'll be releasing next week. But just talking about our pipeline, I mean, we've talked about we look for our basic fundamentals. We're looking for 100,000 square foot industrial opportunities and multifamily opportunities as well. Low cost basis, great fundamentals from tenants, cash flows, areas where we can create value. So we continue to release those. As mentioned, we've just this year alone, we've closed around 8 opportunities for our investors. So we're excited to continue to release more of the rest of the 2025.
Definitely. And as a team here, we're collectively focused on identifying these opportunities, sourcing them, underwriting them, getting a robust knowledge of the market, networking with brokers, and our entire team here is dedicated and committed to doing this every single day. So we're only bringing those opportunities to the investor group as the final step in the process, right? So we probably see 50 plus deals a week. We have filtered criteria that we work through with our team to identify the most compelling opportunities before we go to LOI and purchase and sale agreement, before we go through our due diligence. So all this is happening behind the scenes. And we love to show our process to their investors if you guys are interested. But yeah.
We have a quick question here.
Quick question.
Yeah, great question. So the question are there any plans for capital improvements or CapEx expenditures for this older building? So yeah, that's a great question. So building itself, here's a great picture of it, has been extremely well maintained over the years because it's a large Fortune 250 company. They've done a really, really good job maintaining the building. We've actually also built in the model almost $100,000 a year of maintenance costs just to ensure we're keeping and maintaining the building. The tenant, as well as ourselves, actually just did a recent study on the roof, for instance. Because the roof, as an owner of industrial real estate, is usually one of your highest expenses. The roof they had to get a sign off to get their 10-year extension. They had to sign off with their civil engineer and their engineers that the roof would be stable because they're storing seeds in there. So that roof needs to be perfect. There can't be any water seepage. Otherwise, those seeds germinate. So that's huge for them. So we acknowledge that we are going to continue to build up a reserve as part of our sources and uses here. We do have fees, you see, reserves. So we have, I believe it is just under $150,000 of capital expense reserves, just on top of what we're typically distributing every month, putting into those reserves. We have an extra $150,000 we've set aside. So that's a great question. Unlikely that we need to do anything with major CapEx items. Also part of the extension, which the seller is paying for, is a remodel of the parking lot. So they're contributing, I believe it's somewhere around $250,000 to remodel the parking lot for the forecourt tab of the tenant as part of that lease extension as well.
Yeah.
Good question. So the question is how do we source this deal? So this is really coming from our brokerage network. So we've been working this deal actually since October of last year. So October of 2024, we've been working with the seller and our brokers on finalizing what would be the extension for the tenant and really working through that with the brokers and the sellers. And we've actually built a great relationship with the sellers. They're actually locally based here. So we've built up that relationship over that time period as we're renegotiating this lease. But really, it came from our brokerage network we've built up over the last few years.
Yep.
Great question. So going forward here, obviously, like I said, questions, please ask. We love answering and interacting if there's anything else that's coming up. Talked a little bit about pipeline opportunities. I guess we'll talk a little bit about our multifamily.
Yeah, let's talk a little bit about just highlighting one in the last 5 minutes we have today, our multifamily development deal, Access Apartments in West Dallas, right outside of Milwaukee. It's a 147 unit, 2-phase project. We did a roundtable last week in depth on this project, so we just wanted to quickly highlight it today. So if we jump to the next slide, high level, as I mentioned, 2-phase project. We're already in the capital raise right now. We're already 25% raised in the first few weeks. In receiving significant interest. And that's really a function of a couple different things. Number one, the market, the vacancy, and the overall development package that we've put together, which includes a 27-year TIF, right? So we're building 42 garden-style units, which we've built numerous times and really honed on this model. We've really made it cost-effective, driven efficiencies into the model with our architect and construction team. So we'll be building 42 units in October, and then the 102 units of stick-over podium that you can see in the imagery, that will be constructed next March. So if you go back to the why invest or why we like the project, number one, we've set up the project with really strong returns. We're looking at an LP or limited partner IRR above 20%. And we're able to achieve that because of our incentive package, right? So while it's a great market and the fundamentals make sense, as you can see right here in the Milwaukee Metro, and Nick will get into a little bit why we love this market so much. But because we've set up this project with the 27-year TIF, which is max duration, and 100% of the property tax is rebated to us during that life of the TIF, that sets the project up for a lot of success. And of course, as a K1 equity investor in the opportunity, we're able to pass those depreciation benefits. And now with 100% bonus depreciation, those benefits are significant to us and our investors. And we typically, like on this project, we'll do a cost segregation study. We'll take out the 5, 7, 10-year property, forward accelerate that depreciation on those assets in a shorter timeline to maximize those depreciation benefits. And then, of course, as a multifamily developer, we love the multifamily asset class, and we love specifically this market. There's no better hedge against inflation with annual one-year leases. When we turn these leases, like we're doing in Oak Creek right now, we're getting 3, 5, 7, even 10% bumps, depending on the unit type, as there's low vacancy and significant demand for quality apartment units in close proximity to Milwaukee. So I'll turn over to you, Nick, to talk a little bit more about the market.
Yeah. And one of those things too, Josh mentioned on like depreciation benefits. I mean, if anybody has specific questions about those and how that affects you, because if you have multiple real estate investments and other passive income, we'd love to dive into that for you and how that can benefit you really long term to really take advantage of how you can defer taxes or delay taxes or tax strategy. Market specifically, so projects in West Allis, Wisconsin. This is immediately west of the city of downtown Milwaukee. And why we love this market is really the rent. I mean, we've seen significant rent growth, extreme low vacancy in the market. There really hasn't been new opportunities or units delivered in downtown Milwaukee just because they don't offer the same incentive packages and ways to get projects done because they have really high basis in land. Here, we have a great municipality. The city is really business focused on the new development and focused on, again, progressing and doing a lot more. And here we're centrally located. We're 4 blocks from the highway. We're walking distance to shops and to stores and to that live, work, play, and to the park. So we really it creates all of the location benefits on top of all the benefits we're getting from the TIF and the rental growth that we're seeing as well.
Right, and with just going back, looking at the proximity to Milwaukee, as Nick highlighted, that's super significant. The rents in downtown Milwaukee are much higher, 50% plus higher than what we're underwriting here. And just as another added benefit, we're underwriting our rents very conservatively compared to what our market study showed. So we're underwriting 10 cents to 12 cents per square foot lower than our market study. If we're able to achieve our market study, our returns increase from what we're projecting right now based on our internal model. So, I think when workers or people that want to live in the proximity to Milwaukee, West Allis is a great location. Land's less expensive. Right, you have a quick ride downtown, access to all of Milwaukee's amenities in just a short drive, and you're paying rent that's 50% plus less expensive than living in downtown Milwaukee in a high rise, which everyone does not want to do. So this is a great option for many types of renters.
Absolutely, and that's one of the things we'll see is being conservative on the rents and also the ability for those rents to grow. We know those rents will be achieved in the competitors in the area. We'll be delivering a newer product, and we'll also hopefully catch up with some of the neighboring communities that might have higher rents, so you can even see more outsized returns. Because even just looking at the basic investment fundamentals here, as talked about, year one there's no cash flows. The first garden style buildings, 42 units, are going to take approximately 8 months to construct, so those will deliver in summer of 2026. The mid-rise will take just over a year to construct, so that will deliver in spring of 2027. And usually we're assuming conservatively a 12-month lease up from that time period from each of those. So likely stabilizing towards the end of 27, early 28, which comes to that year 3, where we'll target some sort of stabilized financing or target a sale in year 4, showing where we're at. And the fundamentals here are we're building at a 7.39 going in yield on cost. I mean, if you take your current NOI and you divide it by the cost of what we're building this for, and backing out the TIF value as well, you're building this at 739. And right now we're seeing properties like this, even with property we're currently in the process of selling, trading in mid to 5%. So you're creating that 1.5% to 2% spread the day we build it. So you have that built-in value the day we're constructing this project.
Right. I think in general, as zooming out and taking a step back and looking at the multifamily development process, there's a risk return profile here, right? We're not just going to buy an existing asset, we're creating the value, right? And there's a lot of things that we mitigate risk across the spectrum on the pre-development side, on the construction engineering, on the financing side, going to a lease up, making sure that our model is super conservative, like Nick said, in our absorption. If we know as a team we can execute and beat these underwritten assumptions, we know we can outperform the returns that we're projecting here, which are already, we're really comfortable, right, with these returns. We're really excited to bring this to the market. And I think that's why the capital raise is going so efficiently. And wrapping this all in one beautiful package is the TIF, right?
Right.
Which really is the driver that make this project exciting, to get to that yield on cost, to drive returns for our investors. We've done this many times. As Nick said, we're going through a sale right now, sub 5.75 cap. And clearly here we're building, 150 to 200 bips of yield spread and value creation through just day one projected net operating income, right? Which is a function of our rents, which are conservative. So
right.
If we can beat those, our returns will continue to be outsized, hopefully past what we're showing here.
Yeah. So either way, it's two opportunities we're extremely excited about for the Normal Illinois, so F Street Normal LLC, and then F Street 92 LLC. Two great opportunities we're very excited about. We also have one more coming up next week that we'll release. So lots of great things going on, great opportunities for investors to beat the market, create additional value, alternative assets. So we'll open up to any other questions. If there's anything additional, we had two great ones earlier. If there's any other questions, go ahead now. Otherwise, we'll sign off, and you can visit fstreet.com. Or fstreet.com/invest, or reach out to Josh and myself, josh@fstreet.com, nick@fstreet.com. We're always happy to talk. Awesome.
Looks like we have no questions. So thank you all for your time today. I know everyone's busy, so appreciate you joining us. As Nick mentioned, we're always available to talk, and we only have 20 to 30 minutes on the presentation, but if we can be a resource and answer any questions you have, we'd love to do that. So thank you for your time.
Thanks, everyone.